The world hit an inflection point in 2008, which was the global debt crisis. And we get the ramifications that spread on in 2012, the European crisis. And that continues to rumble on to this day. What happened back then was something remarkable. Is if we think about how GDP is created, the growth of economies, it's population growth, productivity, and debt growth.
Raoul Pal, a former Goldman Sachs executive, is a well-known figure in the finance world. He's the brains behind Global Macro Investor and Real Vision, where he shares deep insights into the complex finance industry. Raoul's knack for predicting market trends, especially his foresight during the 2008 crisis and the recent COVID-19 pandemic's impact on Bitcoin, sets him apart. What's fascinating is his life decision in 2004, when, at 36, he chose to retire from fund management to focus on personal goals, showcasing his commitment to both professional excellence and personal fulfillment. In today's insightful video, Raoul Pal takes us on a deep dive into the intricacies of global economics post the 2008 debt crisis. He intricately unfolds how this crisis has not only reshaped economic strategies, but also led to innovative approaches to managing debt and interest rates globally. Raoul expertly analyzes the significant impacts on technology and cryptocurrency markets, revealing their unique responses to economic shifts. Moreover, he provides a forward-looking perspective, discussing current economic trends and forecasting the transformative role of AI and renewable energy in future economic growth. Join Raoul Pal in this compelling video for a comprehensive understanding of the dynamic interplay between past economic events and future possibilities. For valuable financial insights that could significantly enhance your investment strategies, I highly recommend watching this video until the end. You'll find essential tips that have the potential to exponentially grow your investments. Don't forget to engage with us by liking, sharing, commenting, and subscribing to our channel for more daily informative content like this.
We've had aging populations in most of the Western world. The US is less aging than others, but still aging. But debt growth in 2008 stopped, basically. And we had a debt jubilee. Now, debt jubilees, most people would think of, you forgive all the debts. We didn't. We did this magic trick, which we said, you don't need to pay the interest on the debt. We'll make it all zero. And every central bank around the world cut interest rates to zero. Okay, that created an opportunity for every government to refinance their debts. So they all refinance, and they refinance them in this 3 to 5 year time horizon. And that set off a cyclicality to the economy that we've never really seen before, that every 4 years we get economic weakness, the increases of the balance sheet and use of interest rates as they come to refinance the debt. What I found out in my work that's become quite well known called the Everything Code, I found out that, in fact, the use of the central bank balance sheets was used to pay the interest on the debt from the previous cycle. And this will become relevant in a second. So they're monetizing the interest payments, which is pure debasement of currency. And debasement of currency means that the denominator, the purchasing power of that currency, goes down, and it makes the price of assets look like they're going up. But they're not really going up. When you divide, for example, the S&P 500 or gold or real estate by the Fed balance sheet, they've been flat since 2008. And I discovered within that process that only two assets actually have risen versus the debasement of currency. That was technology stocks and crypto. Both were in secular uptrends. So this, like clockwork business cycle, which is based around the debt refi cycle, happens to be exactly the same as the US election cycle. It also happens to be exactly the same as the Bitcoin halving cycle. So all of these cycles are at the same time every time. So here we are today. Today, we're at the bottom of the business cycle. This is the kind of recessionary era. Businesses are laying off staff. Inflation is starting to fall sharply. The forward-looking markets, technology and crypto, priced in a recession last year. And they've been recovering since because they've been following the forward-looking indicators of financial conditions and other things. Right now, stuff like the Russell 2000 and oil is living in the present day, which is slow economy. So they're at their lows. And everyone's like, what the hell is going on? Why are these tech stocks going up and everything else is going down? It's because they're forward-looking, as it is their job. So I've been very bullish. I saw the liquidity cycle, which is the key driver of all assets. The liquidity cycle is based around this interest rate cycle, which is based around this whole debt refi cycle. Liquidity started bottoming last year in October, November, December. And that gave us the signal to start getting long both crypto and technology. And that's been, phenomenally good. I mean, this year, the Nasdaq's up 45% and crypto is anywhere between 80 and 500% this year. And that's got people scratching their heads. But our forward-looking indicators of the business cycle suggest we're going into what is, right now we're in macro spring. That's when the weather kind of gets warmer every day, but sometimes it's raining and sometimes you've got a frost and other times it's hot and you're like, it's always confusing. That's macro spring. We're about to start moving towards macro summer. What is macro summer? Macro summer is when interest rates are falling, inflation is falling, and growth is picking up. That's the kind of holy grail for macro and for investing. And we should be in macro summer for all of 2024 and into 2025. And so my forward-looking basis is that the economy picks up, inflation keeps falling. I think it'll overshoot to the downside, which is the opposite of everybody else's narrative of sticky inflation. And I think the markets are already showing you how excited they are about this idea, because we've just gone through a ridiculous rate cycle, kind of an unprecedented rate cycle on the back of the unprecedented inflation. That inflation, I think, was just driven by the pandemic. If you shut down, all demand and shut down all supply and then bring it all back on at the same point, you create chaos. Exactly the same happened after World War II. After World War II, suddenly everyone came back into the labor force and factories had to retool from making munitions to making cars and washing machines and whatever. And we got a massive inflation then. But then what happened is it worked its way through and we just had strong growth going forward. So that's where we are today. Go on.
Oh, no, you can continue.
So we've still got the problem remaining of that GDP formula. How do we pay for this bloody debt? Because it keeps going up. The higher interest rates go, the more bonds they have to issue, which is why I think they want to bring interest rates much lower than people expect by being so late in hiking, so they can undershoot and have the cover to paper over the cracks in the system yet again. And they'll use like the commercial real estate and the banks as one of the excuses to do it, to start using the balance sheet. But we've still got the problems with the economy is it's not growing fast enough to pay the interest on the debt. So if the economy on average is growing at 1.75%, and let's say interest payments on debt is about 2%, and the government's 100% of GDP in debt, that's all of GDP just to pay the debt. So what you need is to grow GDP. And to grow GDP, you either need the population to grow, well, that's not going to happen, or you need productivity to grow. That's technology. So productivity growth is what I'm really looking at. And it's not this cycle story, but by 2030, we will see AI solve both problems. AI and the robots are new demographics. They're new productive units in the workforce of infinite scale. So we can now have an infinite population of productive people in inverted commas, and that will start driving productivity. The next part of the equation is we need to bring the cost of energy per unit of output down. And it won't come out of fossil fuel markets. It'll come out of renewable energy plus nuclear energy. If you lower the cost, the average per dollar barrel of oil price over the last 60 years has been about $40, inflation adjusted. But if you change to a new source of energy or bring in other sources of energy to make an excess abundance of energy, and you bring it down to $10, that has a massive multiplier. So my big picture is we're about to go through an economic revolution, but we're not finished with the downside of slow economies. And that's going to mean more and more use of the balance sheets, ongoing increase in asset prices, and this ongoing cyclicality of the economy.